Australia's economy right now, whether the stats show it or not, is in its worst position in years. Are we going to get out of this rut through a soft landing? What will happen to GDP? What will happen to inflation? Another bout of inflation coming, or is that it? In this episode, we look at the economic forecast from both the RBA and the IMF and other sources to highlight the two biggest risks that I see to the property market and the economy right now, but also what different cities are likely to do both in terms of residential and commercial property market performance. Hit the subscribe button, hit the like button. That's good for me. Let's go. Now, to cut to the chase, this is how think tank expect house prices and commercial property prices to fare over 2024. Residential homes, they expect Sydney and Melbourne to be basically sideways. I'm more bullish on Sydney. I think it might do between 5 and 10% this year. Melbourne, maybe not so much. Adelaide, it will continue growing, but I've said this for I think more than a year now, outside the ideal buying window. Brisbane will do really, really well for those of you who don't really need so much yield because you're making $500K to $1 million a year anyway. And Perth, in terms of capital cities, is still my number one pick for both yield and capital growth. Residential units is much the same sort of picture, but still I would not buy a high-rise apartment in any of these capital cities because long-term, even though right now units are cheap, there is a widening disparity between the demand for units and houses over the last 35 years. So don't be sucked into that cheap unit play. If you only have 500K, you can still buy it in a capital city. You don't have to get a unit. Office market is going to be likely fair, okay? It's had a lot of trouble in the last 3-4 years since COVID, basically. It's starting to pick up a bit. Employers, yes, they are asking a lot of their employees to come back to the office, but there's a lot of resistance against that, and I don't think it'll ever be what it used to be pre-COVID. Retail, once again, with the rise of Amazon, other online retailers, it's still soft. Overall, it's likely to be weak in Melbourne and Sydney, and good to fair in Adelaide, Brisbane, Perth, where I think there's much better asset types that you can be buying than retail commercial. Industrial has been the darling for over 5 years now. Even before COVID, it was doing incredibly well, almost since 2015, when really Amazon made the big decision to come into Australia in the years following. So Sydney, Melbourne market and industrial still very strong. Adelaide, Brisbane and Perth is, according to think tank, good, but I would actually flip it around and say Sydney, Melbourne, yes, strong. Adelaide, Brisbane, Perth, very good. It's saying Perth is likely to outperform. It's got the arrow upwards, but why buy a yield of 6% industrial in Perth when you can get the same 6% in Brisbane with a larger economy? Remember, commercial is a different beast to houses. Houses, it's an essential need. Commercial is not always, so tenants can be quite volatile, can be fickle. So I would pick Brisbane as my main go-to for commercial if I was investing in commercial. Now let's really discuss this soft landing. This is the Reserve Bank's updated economic forecast. You can see the GDP number, they've revised slightly downwards from November 2023. You know, it was a little bit higher across here. And in February 2024, their latest revision, it has come down. So for example, in June, they're expecting GDP growth to be 1.3%, not 1.8%. They're expecting 24 December number to be 1.8%, not 2%. June 25 to be 2.1%, not 2.2%. So overall, I think right now, as we stand here in March 2024, we're basically in the most dire part of our economic cycle. We don't know it yet because the data only reflects or reveals itself in a lagged effect 3 months, 6 months later. But right now, things are not good. Now, of course, these forecasts and estimates can change, but I think it's very unlikely for it to go, let's say, in June 24, from a positive 1.3 to a negative 0.5 or negative 1, which would really mean a significant recession. Unemployment rate is definitely likely to go up. I've done so many videos on that. Long-term unemployment rate for Australia is around that 6.5%, in which property prices in Sydney boomed in the last decade. Right now, we're expecting unemployment rate, according to the Reserve Bank's official forecast to go up to 4.2% in June 24, then 4.3% in December by the end of the year, and then mid next year 25, 4.4%, at which it levels out. So yes, that is going to cause tens of thousands of people pain, but I don't really see that as being a huge issue given that our long-term unemployment rate is that around 6%. So that bodes well for a soft landing as well. Wage price index, this is the one that concerns me. All right, so yes, it has been fairly stronger than previously, 4.1 in December 23, June 24. But you can see going forward, even though the economy is likely to get better, our wage price index is likely to come down. I've said this so many times, including my last video. How are people going to get ahead when the economy is doing okay? I mean, not a recession, but a fairly soft landing. House prices going up, commercial property prices going up, unemployment not really going through the roof, but wages stagnating and once again going up and then dipping back down in 26 in terms of its growth rate. That really creates a vacuum in the middle class. If you're an average person making, average to decent income, how are you going to get ahead with everything around you getting more and more expensive? This is the key issue that I think needs to be discussed, and it means that long-term, the Australian economy is a bit jittery because when the middle class thrives, the middle class is what consumes the most amount of goods and services, and that's what creates a healthy multiplier effect in money markets, in capital markets, and in real economic buying and selling commerce markets. Especially when you look at consumer price index, yes, it is likely to go down. June 24, the estimate is 3.3. Remember, the range that RBA is going for is between 2 and 3%, is going down to 3.2. Their estimate suggests by the end of this year, then even lower. By the end of 2025, it's going to be well within that threshold. But check it out, even in 25, 26, it's 2.8 and 2.6% respectively, and wage price increases 3.4 and 3.2% respectively. So where are your gains? All of your wage price growth is being eroded by inflation. Of course, none of this data shows currency debasement. Ever since fiat currency with monetary easing, quantitative easing, we've had currency piled in, money supply increase, which further erodes your purchasing power. It further increases costs of living. And if your wages are only 3.4, 3.2%, then you're not keeping up with inflation plus currency debasement, which equates to over the long term between 7 to 8%. That's a really important number to understand, guys. Do you remember last year how the IMF, the International Monetary Fund, flew to Australia and cast a whole bunch of negativity that our economy was so bad, and then the major newspapers picked up on it and everyone was like doom and gloom? But despite all that negativity, here's the actual raw data behind the media headlines of what the IMF predicts, which, by the way, hasn't been the most accurate of predictors, much like the Reserve Bank of Australia. So in red, you've got real GDP growth. So they're suggesting that our real GDP goes down from around 2.8% back at the start of the decade to around 1.8%, and then it turns around in 2025, starts going up more towards the low twos, which was similar to what the RBA had forecast, and our inflation rate comes down consistently again and again and again, and into 25 it's at about 3.4%, and then going on from 25 it's down within that 2 to 3% threshold that the RBA suggested. So the International Monetary Fund, which is typically quite negative, quite bearish, and resulted in a lot of negative headlines at the start of this year, end of last year, is in fact quite akin to what the RBA is saying, and it's also suggesting a soft landing. There's no recession, there's no spike in inflation according to them for Australia. Let's deep dive those numbers real quick. So real GDP for 2024 from the IMF's forecast 1.4%, then it goes up next year 25 to 2%, up again in 26 to 2.2, and then 2.3 in the years after. So there's no recession according to them, and they have a really good bird's eye view of what's happening. Of course, the US economy is stronger than our economy at the moment, but they're forecasting the US economy to be a little bit more softer next year, and so you might get all of this global recession talks, but our economy is likely to pick up. In terms of unemployment rate in 2024, the IMF is predicting for Australia to have an unemployment rate of 4.2%, next year 25 to go up to 4.4%, then 4.6%. So once again, broadly speaking, very similar to the RBA. They're not really chalk and cheese, so it gives us some confidence that, in triangulating the different sources, that this is probably the likely outcome. Unemployment's not going back to its long-term averages of 6% anytime soon. And then the one that I think everyone wants to know, iron ore prices, iron ore index. Now look, this is the harsh reality. In 2024, iron ore prices, projections from the IMF, 137, next year into 25, 124, then further down, 114, leveling out at about $100 over the long term. Of course, it's very hard to predict 6 months from now, let alone 3 years from now. I used to be an oil and gas analyst at JP Morgan, so I know how often I was wrong. If you try to understand this in context, back 3, 4, 5, 6 years ago, the iron ore price was actually very similar to what they're projecting for this year and future years, 101, 135, 156. It only spiked up here just post-COVID and then came crashing down again. And then it's been sort of up and down, although on a yearly level quite stable, but monthly, a lot of volatility. So it will be a really good test over the next 2 years of how the Perth property market performs, because clearly we'll see iron ore prices, other things like nickel, etc., coming down. We'll really see, hey, is the Perth property market divorced completely from mining fortunes, which I don't think is the case, but like I've demonstrated over numerous videos, my hypothesis and confidence is still that the next 2 years will be tremendous for Perth, because the solid on-the-ground economic reality is there's just simply not enough houses. The economy is much more diversified from an employment perspective versus what it was 5 or 6 or 7 years ago. And despite mining still being a key linchpin of WA, of Perth, the reality is that that's where the economic output comes from. But a lot of those mining processes are capital intensive now, being automated versus 10 years ago. So yes, I think absolutely this Perth bull run is not going to last, years and years and years, but there's probably another 1 or 2 solid years in this short-term cycle, but I don't expect there to be a sudden drop of 20, 30, 40% at a city level in Perth, because as I've demonstrated, this boom in Perth is not simply because of iron ore. Mining capex has not gone up over the last 3, 4, 5 years. Employment in the mining sector has not mirrored what it did 10 years ago. And the price rises in the housing market in Perth are because of owner-occupiers, not simply speculative investors. All these things have been backed up with data in numerous videos before. So if this narrative of a soft landing does eventuate, what does that mean for house prices? Well, the Financial Review reported that the widespread drop in global house prices that hit advanced economies have largely petered out, according to OECD data, and leading economists predict that the deepest property downturn in a decade has hit a turning point. Of course, last year property prices rose a lot. In Australia, it was 2022 that they dipped. The rest of the world is a little bit different. But the rest of the world is now also rising in prices alongside Australia, at least most of it. US property, you can see rising. Australian property rising since 2023, as I said. Even the UK property and their economy is really very shoddy compared to ours. Really in a lot of pain, but even their house prices have turned. It's just the Eurozone. As always, just like in the GFC, it was the Eurozone that took 4 to 5 years to come out of the GFC. They always take the longest to come out because they're so heavily impacted by the Russia-Ukraine war. The economies structurally, from a bedrock perspective, are much weaker than the UK, Australian, Canadian, and US economies. So the moral of this story is the Australian economy is basically at its rock bottom right now, but going to get better over the next 18 months. House prices, commercial or residential, are likely to go up in a lot of locations. There's 2 big risks that I can see that could be are like a rhino stampeding through this narrative, and Moody's has explained this according to their chart of likelihood of risk versus economic severity of risk. And in my mind, the two biggest risks are Russia's war in Ukraine escalates. If for some reason France or Germany, they send their own forces, NATO forces, into Ukraine officially, that would escalate the war. That would mean inflation rises again because global trade patterns create bottlenecks again. Then that could mean further monetary tightening. Interest rates go up higher to combat that inflation coming from bottlenecks and economic uncertainty, and confidence would just drop. And so I think that's a big fear and a big curveball that everyone should understand. And the second thing is China's recovery stumbles. China's on its road to recovery. China's economy goes up and down, up and down. But you have to remember it's still growing faster than Australia's, and it's much, much larger than Australia. So we like to say China's struggling relatively compared to what it used to be. It is struggling, but it's still healthier and growing quicker than we are, than the US is, than the UK is. The more the housing market struggles there anecdotally and financially, more money flows into the safe haven of Australian commercial and residential real estate from Chinese people. But of course, we want China to be healthy from a fundamental economic perspective, because they are who demand what we've got under the ground. If we can't sell what we have under the ground, then Australia really doesn't have any big competitive advantage globally. We need to be friends with China from a long-term economic perspective, and we need them to be healthy. We need our friend to be strong and fit, because he's in some sense carrying us on his shoulder for the next decade, whilst hopefully the Australian government invests in capital, technology, innovation, and productivity so we can diversify away from simply mining. But if China stumbles and falls in a bigger way than what they are at the moment, then our soft landing may be at risk. Let me know if you want me to do a deep dive on China and our risk to China. If that's interesting to you guys, leave the comment China below. Guys, hopefully that was useful to level up. I really want you to make solid property investing decisions based on a keen understanding of an economic landscape. Let me know what you think in the comments. These are my synthesized views. Guys, hopefully that was useful. Hit the subscribe button, give it a like, and let me know what more videos you want in the comments. My name's PK, and I'll see you next time. See ya.